day all. Ira Epstein of Linn & Associates with your SPDR ETF video for this afternoon of Tuesday. And we are now at the 28th of January 2020 and about 4:50 p.m. Central Time. I've already put out the subscriber video, and remember, while it's a subscriber video right now, it is free to all of you that want it. Just go to our website at www.iraepstein.com, go to free offers, because we got to send you a user ID and password, and click on the SPDR video, and we'll be sure to get that out to you so you can see it. I try to get those out by 4 o'clock each day. Sometimes I miss it a little bit, but we're about there. You know, we were talking, were we going to get a Tuesday reversal in the markets? And if, I think I had mentioned the Stock Trader's Almanac, Yale Hirsch's original book. I know his son's been carrying it on since then. And you got it. If you look behind me, look at the green. These are the QQQ, which is the NASDAQ, the S&P 500 ETF, the Dow. You've got the different sectors that jumped. If you think about the markets that had seen the risk-off mentality hit, that would have hit the gold, and you were up originally on the news. The miners, they've all fallen today, and that's what I'm saying. They should have fallen back if you were going to get the rally in the stock market. Silver fell, TLT. The typical areas and the energies were up a little bit. Now, the currency sector's all over the board, and be careful with the FX, the British pound. They're talking on Thursday will be the monetary policy meeting, and it's up in the air if they're going to cut interest rates or not. So you're going to get a reaction, yes or no, to that. That's something to watch. Remember, tomorrow we have our FOMC meeting. We're going to have our announcement in the afternoon. It's widely expected the Fed is just going to sit pat. What nobody knows is the impact that's going on this Wuhan coronavirus. United Airlines today, as of February 1st, forget going to China on their airlines into most of these areas in China. Not happening. Macau, not happening. I heard today that the foot traffic in Macau is down 70%. After the close, we saw warnings come out from Starbucks. Their store's doing exceptionally poor in China. Not that their business bad. People aren't going out. They don't want to be near other people right now. We're seeing that stores such as some of the major fine jewelry getting hurt. The clothing stores, I'm talking the big chains, getting hurt. Traffic down. They're closing different stores down in a number of areas. They have to. They're just not getting, why have the help there and all the other things. I don't know that they're closing permanently. I'm not saying that, but there are going to be problems. Let's assume you own a cinema chain and nobody's coming because they don't want crowds right now, the government. Who's paying the rent on that? I mean, there's much to take into account, and it's going to play itself out. When we look at the technology sector, I want to come back here and show you something. I often say charts don't leave gaps. Now, I'm the first to also say that ETFs and SPDRs trade a little bit different because they get the edge of seeing how the futures have first done, and then they come in well after that. Remember, it's just about 5 o'clock. We're going to open the futures markets for all your major stock indices in minutes as I'm talking. Well, you won't open these different SPDRs and ETFs until 8:30 in the morning, right? So they have to digest whatever's coming in. So we had a market that gapped down because they had a chance on Monday morning to see that the stock indices had fallen apart. Now you've got a gap in there. Today the market makes its attempt at filling the gap. That's my point. Charts like to fill gaps. Was today anything more than that? To prove me in my head that it wasn't, that it is something more important, you got to go back through the high that you made last week, and this high being on Friday when the market was 98.83. Other than that, this is a bit of a relief bounce off of a big break in the market. That's my interpretation of it. Are we trending? No. What I have here is a pattern of a higher high and a lower low. I think you'd agree with that if you're looking at the swing line. So you're not trending. Where's the market's moving averages? Well, we fell to the 18-day average. I call that the line in the sand. And if you're a regular viewer of my videos in any manner, my theory is that the market likes to work around this 18-day average of closes. When the market's above it, the first break to it is often met with support. I'll take you back here. If I had it further back, I'd prove to you like right here. That's typical of what that average does. Now, that doesn't mean you always bounce away from it. You might get under it, and when you're under it, rallying up to it makes it resistance. But I use it as a filter on the swing line, and right now what it's telling me is I have bias up, but I have no trend in the market. It's disappeared. I then look to see where Bollinger Bands are, and the reason is these black lines. The market is going to trade within them 95% of the time. It's not magic. It's called a mathematical algorithm. It's designed to look at the range, the velocity of the moves. If you go on to Wikipedia and you put this in, it'll explain the whole formula. John Bollinger created it. Used to know John very well. He would be on my old TV show, Stocks, Options, and Futures, from many, many years ago. And it was brilliant. And I became a fan after I met John and I saw the importance of it. And staying on it is a sign of strength, not weakness. But staying over it, you're not going to do it very often. So you've got to watch that. What else do I watch? Momentum. I prefer the slow stochastic study. People like relative strength. There's so many different momentum studies. There's something for everybody. I happen to prefer this one. And the reason I prefer this one is the market has a characteristic to it. And off those characteristics, I'm able to understand the psychology of the market better. I think it was Peter Elides at a service, and he was able to understand the characteristics of the markets with that. Well, I still see the higher high, lower low, and I see momentum lost. That often leads to a challenge when it happens of the 18-day average of closes. You did it all at one time. When it's done it's past tense. This has already happened. Now what next happens? If this market takes out yesterday's low, Monday's of 94.71, you could end up with lower highs, lower lows underneath the 18-day average and have another wave to the downside. So I think yesterday's low is going to be important in this market. In the XLI, where did you fall to today? You went to the lower Bollinger Band. What's my rule of thumb? You don't have to follow this. My rule of thumb is the first time you hit a Bollinger Band, upside or downside, I'm expecting pros to take some money off the table. That's what I think happened. Did the trend change? No. You still have lower highs and lower lows in the market. You are oversold. Very important to see that. That tells me I don't know that the pros will get too aggressive against that 18-day average of closes if it bounces there. In the energy sector, feeble, tepid, weak. What number do you want to, what adjective do you want me to put on it? Because there's numbers involved too. Look at how many days now you're under that lower Bollinger Band. I think it's 6. That's rare. It's also a sign of extreme weakness, not strength in the market. When you lose the embedded reading, when the red line gets over 20, I'm going to change my tune. I'll give you something else to look at that point. Not there. Then we get to the QQQ. Okay, so here's a higher high, lower low. Now, in this market, what if you take out this 217.19? You could end up at that point with lower highs, lower lows under this, and wherever the Bollinger Band comes in could be your next support zone. Let's assume this market suddenly gets good. To throw out all the bearishness that's come in, and I'm not saying it would turn the market, but I am saying it would throw it all out, you got to go through Friday's high. That's pretty much an all-time high. Emerging markets. You fell enough to get to the lower band, and you climbed back into it today. You didn't change the picture here, but you're oversold as can be. I will preach it over and over. The first challenge is, especially if you hit an 18-day average, that you hit that lower or upper Bollinger Band. I think the pros take some money off the table. I don't see a trend change here. GLD, you went up to the upper Bollinger Band for the first time yesterday. After being here, you had done all this correction. You got thrown back today. Are you overbought? You betcha. You're definitely in overbought territory, and you're not trending. I'm aware, and I can visually see the rally we had, but you still have the lower low and a higher high on the chart. Then you come to the two parts of the gold miners. Well, you keep hitting this 18-day average, just back and forth, whipsawing back and forth in it. The same here. It's really not giving you much in the way that you can hang a hat on one way or the other. TLT. Well, what we know is people ran to the what? They ran to bonds and notes for U.S. securities as safety blankets. We're also seeing that the German Bund in the U.S., there's some narrowing going on there, but you pulled back into the upper Bollinger Band. You didn't break the trend. There's another event happening. The 18-day average is trying to get over the 100. Now, the moving average traders will take that as a more bullish signal. The one thing I didn't expect this year was that we were going to keep seeing falling interest rates. This virus situation has certainly set it off, but if you also look today at durable goods numbers in the U.S., they weren't pretty. Maybe this whole thing is just setting off something else in the economy. Nothing grows to the sky is another way to look at it. Energy. We've been coming down fairly hard on this ETF, the USO energy. We bounced to the right-hand side. Nothing bullish about that. Still a bearish embedded reading. Still pretty much a straight down chart with a day's bounce. In the euro versus the dollar, all you did is bounce to the right-hand side of the Bollinger Band. You haven't changed the pattern that it is losing to the dollar. Who does worse with the Chinese economy if something goes wrong in China? The U.S. or China? I think you'd agree with me. Europe does more trade. It's more important to them, and that is one of the problems. The U.S. is doing its best. We're very conciliatory. As I understand it, offering all we can to China to help them out. This is a world event that's going on. This is not a Chinese event. Unfortunately, it's centered in their country. Spreading, that's what we're all nervous about. So you've got to keep your ears open, and you've got to be listening to the CDC and the WHO. And remember, one day doesn't change this event, and the markets reacted one way. I haven't seen China saying the event is crested and the worst is behind it. That's what I'm looking for, or getting close to it before I'll feel comfortable in financial markets. Again, if you like what I do here, you're probably going to really like my afternoon ETF spider. Go to our website, www.iraepstein.com. Click on the free offering for that particular video. We'll send you out a user ID and a password so you can enjoy it. I'm Ira. You have a good day.